I would like to welcome you to this evening's event, Wall Street Bailout, Main Street Fallout. I'm Dr. Cheryl Knoll. I'm the chair of the School of Business at Eastern Illinois University. Welcome to Roberson Auditorium in Lumpkin Hall. We are very fortunate to have such a lovely facility here for our students and our faculty and staff. I would like to recognize the president of Eastern Illinois University, Dr. Bill Perry. Thank you for coming. I would also like to recognize Dean Diane Hoadley, Dean of the Lumpkin College of Business and Applied Sciences. And I would like to express my appreciation to our panel presenters and our moderators for their participation. Thank you. This event is co-sponsored by the School of Business, the Business Solutions Center Partnership, and SCORE. And without this collaboration, this event would not have been possible. It is important that our students and our faculty have opportunities to connect with the regional business community, and I look forward to hosting more events like this in collaboration with the Business Solutions Partnership. I would like to introduce Jeannie Dow, Director of the Business Solutions Center Partnership. This event was made possible because of her hard work. And I think it's funny because I went to her and I said, Jeannie, I've got a proposition for you. I've got an idea. I didn't know what to do with it, but Jeannie certainly did. And so without her hard work in getting this thing pulled together and getting our panel selected, we wouldn't be sitting here tonight. So thank you, Jeannie. Students, I have an announcement for you. Sign-up sheets will be passed from the back of the room to the front. And so if you are in the Business 1000 class, you are supposed to sign a separate sign-up sheet. All other students will be signing a different sheet. So we're trying to keep the noise to a minimum. So if you see pass-up sheets coming along, sign them if you are getting credit for class. If not, just please pass them forward. Okay, thank you. Jeannie will now introduce the panel and the moderators, and I think that we are in for a real treat this evening, and I'm really looking forward to it. Thank you for coming.
Thank you, Cheryl. On behalf of the Business Solutions Center, welcome to the panel discussion. Our mission of the Business Solutions Center is to provide support services such as this event tonight: free education, free one-on-one counseling to businesses, and entrepreneurial education to spur economic growth in the region. We're located upstairs at 3011 Lumpkin Hall, and we also have offices at Crossroads Workforce Investment Board in Mattoon, at Paris City Hall in Paris, Illinois. We have one at Effingham at the Chamber of Commerce and at Charleston at the Chamber of Commerce. So we try to get this help and assistance close, so it's close to the businesses and close to the students here. I'd like to thank all of our panel for agreeing at such short notice to come and give your words of wisdom. We really appreciate it. And I also want to thank WEIU and all the departments at the university. We had somebody specifically for the sound, somebody from WEIU to help, plus the School of Business, plus the Business Solutions Center. So it took a lot of effort. And for the people that came in late, we have about 17 foreigner tickets. They are playing tonight at the Rosebud Theater in Effingham. If you are interested, come see the moderators after the panel discussion, all right? Because we'd love to fill them up tonight too. All right, now we'll go with the introductions. First, we have Dr. Richard Whitaker, and he is an associate professor of finance and the assistant chair of the finance discipline unit. He is published in the areas of financial distress and agency costs. He teaches courses on management of financial institutions and long-term financial management. He was previously employed in credit administration of major Texas banks. He was a loan review manager of one of only 2 major Texas banks which did not fail during the 1980s. As a loan review manager, he was responsible for assessing credit quality, determining loan losses, reporting to the board of directors, and dealing with regulatory agencies. Next, we have Brian Titus, and he's the partner and general manager for Lorenz Supply Company. He was raised on a farm south of Mattoon and graduated from the EIU School of Business with a marketing degree. Right now, he's the president-elect of the Mattoon Chamber of Commerce and is on the board of directors for the Mattoon Area Community Foundation and the Mattoon Rotary Club. Lorenz Supply Company has been in business for 62 years and is a business-to-business supplier of maintenance products and janitorial supplies. He also has retail walk-in business as well as internet sales. And he is a score count client of ours. We have worked with this company, and we're really proud to have him as a client. Next, in the center, we have Chuck Lefebvre. He's the Executive Vice President of the Trust and Wealth Management Department at First Illinois Bank and Trust. Chuck manages 25 employees, which includes several investment professionals, MBAs, and licensed security brokers. He also sits on the Senior Management Committee, Asset Liability Committee, and Disclosure Committee for the bank. Previously, Chuck was a partner in the Champaign Law Firm and is recognized statewide as an expert in the issues which impact individuals during pre- and post-retirement years. All right, we have Jack Schultz, and he is the CEO of Agricel, which is an industrial development firm based in Effingham that focuses on rural America and has completed projects in 14 states. He's also the CEO of Boomtown Institute, where he has toured and talked to more than 350 towns in 44 states. Boomtown USA is a book that was written by Jack in 2004 and is now in its 7th printing and was recently translated into Chinese. Last month, the word agerbs was chosen as a new millennial word in Webster's Millennial Dictionary, and that's one that was coined by Jack and is in his book. And then we have Down Downs. He's the Charleston Community Bank President of First Neighbor Bank. In his role, he leads a team providing all aspects of banking, including loans, deposits, and other financial services. He holds an MBA and an undergraduate degree in finance from Eastern Illinois University, and is also a graduate at the Graduate School of Banking at the University of Wisconsin-Madison. He brings to the panel over 20 years of banking experience in various administrative and advisory positions, along with his tenure in lending, dealing with business, consumer, and mortgage consumers. All right, now for the moderators for this evening, we've chosen 2 EIU MBA students. And first we'll introduce Jake Byrne. He's an EIU graduate with a finance degree who is presently working on his MBA. Jake also played basketball for the Panthers for 4 years and interned on Wall Street this past summer. Next year, he'll be heading back to New York City to work with Merrill Lynch, or now Bank of America, as a derivative sales trader. Jessica Surma is from Tuscola, Illinois. She's a University of Illinois graduate in consumer and textile marketing with a minor in international studies. She will finish her MBA at EIU in general management in December and hopes to find a career that will build upon her international experience and interest. So panelists, there's Jessica ready for a job. Jessica also has helped the Business Solutions Center when we had Camp E3 this summer, which was a business pitch competition with high school students down in Effingham. So I became familiar with Jessica with that. All right, very quickly I'll go over the guidelines on how it's going to work tonight. The panel discussion is being taped by WEIU, and portions of the discussion will be video streamed on the Business Solutions Center and the School of Business's website in the future. Therefore, we respectfully request that you keep any noise or side conversation to a minimum, like Dr. Knoll said, and if possible, stay seated until the presentation is over. The panel will be asked an opening question in which they have 5 minutes to respond. Then the moderators, Jessica and Jake, will ask some set questions in which they have an option to respond or not. If you have a question to the panel, please write them down on the index cards that we filled out, and we will have people in the aisles that will bring them up to Jessica and Jake. We'll close the discussion at 6:15 and have closing statements, which will be 3 minutes each by the panelists. And some of the panelists that aren't going to the Foreigner concert will be available maybe to talk individually after the panel. All right? And you already heard, if you came in late, please sign up on the sign-up sheet. With no further ado, we'll pass it over to Jake and to Jessica.
Okay, thank you. This first question, like she said, is to all five of you. We'll start with Dr. Whitaker first. The question is, how has the Wall Street bailout affected your Main Street business in Central Illinois, and what are you now doing differently in your business to counteract the change in the economy?
Well, I'm the one panelist who doesn't have a mainstream business, so I'm going to kind of provide a little bit of an introduction more from a national standpoint on kind of what the problem is and how we got here. The problem started in kind of the middle of the 2000s, from about 2002 to 2005 or 2005, when we had a very low interest rate environment. A low interest rate environment resulted in increases in home prices. What happened after that is people saw home prices go up, and you brought in speculators, you brought in first-time buyers who said buying a house is a good way to make money. This worked for a while. This worked for a number of years, because as housing prices went up, you really couldn't make a bad loan. Even if they defaulted, the house price increased, so you wouldn't lose money. As a result, the mortgage lenders lowered their loan standards, started making subprime loans and Alt-A loans to weaker and weaker borrowers. What this resulted in was a housing bubble. And so we had a housing bubble for a number of years. A year ago, the bubble burst. Housing prices started to decline. We started seeing loan defaults, and that happened a year ago. That by itself would be a manageable problem. You know, there would be loan losses, there would be foreclosures, but it would be a manageable problem. What happened next, though, was that many of these loans, or most of these loans, had been packaged together into mortgage-backed securities and collateralized debt obligations and sold all over the world. Most of these were rated as high quality by the various rating agencies, so from the standpoint of the buyers, they were supposed to be good. Well, the problem is some of those were backed by good quality mortgages, some of them were backed by poor quality mortgages, and nobody knew which one was which. And so a lot of these were on the balance sheets of investment banks, commercial banks, and you didn't know how good they were. So as a result, the market for these mortgage-backed securities dried up. You couldn't sell them since you didn't know the true credit quality of them. Next comes mark-to-market accounting, which is an accounting and SEC rule that says marketable securities have to be written down to their market value. Well, there was no market, so should they be written down to zero? Well, that would be well below the economic value of these assets. Even if there's high defaults and decline in housing prices, they're still worth something, a fairly good amount relative to book. But many of the investment banks and some commercial banks were forced to write these down, put them in instantly impaired capital positions, caused some of them to fail. And the result was then the financial panic that we've seen over the last 2 months. And it was difficult to invest in banks because you didn't know how good their credit quality was. The result of this was that it froze the credit markets to where banks were afraid to lend to other banks and eventually afraid to lend to even good quality businesses. This is where the financial panic intersects Main Street. And this is a major problem, because if the good quality customers can't get loans, they can't operate their businesses. So the reason for this $700 billion bailout package is to try to unfreeze the credit markets. That's what they're trying to do. And the package was originally to buy these mortgage-backed securities and establish a market for them. It's now kind of morphed into a plan where they buy preferred stock from the banks and directly increase their capital positions. So we're at the stage now, that started just this week. So we're at the stage now where we're going to see to what extent this works in unfreezing the credit markets. So that's kind of what's going on nationally, and now our other panelists can talk about what they're seeing in their businesses.
Mr. Titus.
Thank you. I'm going, my role today, I guess, is from a small business perspective. As Jeannie's mentioned, we've been in business 62 years. We currently have 23 employees. From a small business perspective, I guess how the fallout is affecting us, I'll start with our employees. As everyone knows, if you currently have a 401k or are about to start one, there's been a dramatic reduction, to put it mildly. The gentlemen up here are probably going to highlight some of those items as they discuss future things also. But our employees have seen a dramatic decrease in their funds, and we have a lot of older employees that have already retired from one job and fortunately have joined our as a role of a second career or part-time employment. As you can imagine, when they are receiving their quarterly statements, a shock is, I guess, would be an improvement. They're looking for why and how do I fix what's going on. We're trying to console them by saying, listen, you know, it is on paper, and understand we're doing the best we can to manage those situations to protect your money. As far as from a customer standpoint from our business, we've seen credit tighten dramatically with our customers, which is very difficult for us because we do business with a variety of customer types, to the smallest small businesses, restaurants, up to large industrial and commercial type businesses. When the credit tightens on their end, we're seeing the terms as far as their payment to us greatly extended. As you can imagine, it's a catch-22. With credit being tight for them, we're extending our terms, which we're having to increase our operating money, which again is increasing our expenses in regards to what's going on in the overall economic environment. Also, budgets are another thing that a lot of pressure is on right now. Our customers are coming to us saying that we have X amount of dollars to work with. We're trying to operate within those budgets. We are a value-added supplier. We try to do everything we can to support the businesses that we do business with and provide them valuable products, but at times they want a low price at high quality. You can imagine how difficult it is in certain situations to provide those and service those needs. As far as the credit as a whole, with us being in business 62 years, we've been fortunate to have relatively strong standing with the financial institutions that have aided us to grow our business throughout the last 62 years. Without that relationship, as is going to be mentioned, I'm sure, it's very difficult at this time to grow the business or let alone sustain it. So we continue to build on those relationships as well as continue to add value with the current customers in the marketplace.
Mr. LaFave?
Thank you, and I appreciate being invited on this panel. My role, I think what I add to this panel is to represent a business that really kind of sits at the interface between individuals and some businesses and the investment markets that Dr. Whitaker talked about in his comments. We are, and even though I'm part of a bank, we're really just the investment function of the bank. And really, we can break down what we do into 2 or maybe 3 different categories. One is trust administration. One is investments on sort of a retail level, and the third is retirement plan administration. And what we've noticed is, first of all, that we're kind of having pressure from both sides, both from the customer / plan participant side, people having a lot of fear, a lot of anxiety about what's happening to their individual investments or to their retirement plan investments. And so we're fielding a lot of calls from those people and trying to give them good advice, which quite often just means trying to calm them down a bit about what is happening in the investment markets. And second, we're trying to make very sound decisions on behalf of our clients with respect to the investments that we are making. When we're operating as the administrator of a trust, it's really our responsibility not to turn to our client and ask them to decide what we should be investing in. We have to go make those decisions ourselves. And what we've noticed happening with this credit crisis is a lot of those investment vehicles that have traditionally been considered to be very stable in value and very conservative are the ones that have been hit very hard in the recent market turmoil. So we have found ourselves in a position where many of our very conservative portfolios are seeing the type of market value fluctuation that really should not happen in a portfolio of that type. And it's caused us to put a lot more time and effort into very, very carefully examining the methods by which we can become even more conservative, even more defensive in managing those portfolios. And frankly, given the way the market has been, there have not really been any truly good investments out there, and yet we do have to find a safe place to place these assets and still derive some kind of return. So that's been a very, very significant challenge for our business. And then the other side of that is that it's really required us, because the news changes on a nearly daily basis, to monitor much, much more closely what's happening in the political world and in terms of what research analysts are coming out with, and to try to take what begins as a very difficult strategy and tweak it on a microscopic level very, very frequently. So we found ourselves meeting and discussing investment strategies on weekends and evenings and late at night, times that typically are really not required, because typically in the investment community you can afford to really take the long view, particularly with the type of style that we're shooting for. So it's really changed our workflow. It's changed the amount of time and attention that's being paid to what's happening in particular areas of the market. And at the same time, we're taking a situation that is very, very difficult to explain or to even comprehend and predict, and trying to unravel that into plain English terms that our clients and our customers can understand and take some solace from, and try to, without giving the impression that we know more than we do, still provide our customers with the sense that we are managing their assets properly. So it's been a very, very challenging time for this particular business, challenging intellectually. You know, in terms of the business flow, if you look at balance sheets and profits and that kind of thing, on that side of the business has been relatively stable. But customer relations and the business of making investment decisions has been a very, very difficult thing to do recently.
Mr. Schultz?
We build manufacturing plants around the country, and so I get out to a lot of main streets around the country, and I also talk on my book around the country. So again, get to a lot of main streets. And for the most part, we have found that our customers and a lot of people on Main Street had some of their best times in the first half of this year. And in fact, we had our best first half of the year in 2008. The second half of the year has been much more challenging. During the depths of the credit crisis, when everything was supposedly locked up, because we were working with local banks, and I would differentiate those from investment banks, and a lot of the media just calls them all banks, and I want to differentiate between the investment banks on Wall Street and the commercial banks in our small towns. We were able to finance some projects, and our typical projects range from $2 million to $10 million, but we're able to do a couple of $3 million financings without any problems. Just got back from our annual meeting of the Industrial Real Estate Group. Most of those are from large towns who are dependent upon Wall Street for their financing, and they were in a panic. We really think that this problem is more of a Wall Street problem rather than a Main Street problem, even though the politicians and the pundits would like to say that they're trying to bail out Main Street. I see it as a bailout of Wall Street. And I think and Dr. Whitaker talked a little bit about the history. I'd like to back up just a little bit to December 5th, 1996. And that was the date that Alan Greenspan used the word, or the words, irrational exuberance. And Congress came down on him like a rock because they liked these high prices that were happening in the dot-com era. And there was a hubris that existed on Wall Street that they were willing to bid up companies like Arrow.com or Pencil.com to $6 billion that had no business plan whatsoever, but valued an idea of a pencil at $6 billion. Alan Greenspan backed off, saw a bubble emerging, and instead of raising the margin requirements, let that bubble explode in early 2000. Congress exasperated by doing away with Glass-Steagall, by increasing and allowing those investment banks to margin up, to allow them to have 40-to-1 ratios of debt to equity. 40-to-1 debt to equity, which meant 40-to-1 debt to equity means that if you buy a stock for $100 and that stock goes down to $97.49, is you just wiped out all of your equity. Our commercial banks here in this area are typically working at 10-to-1, a much less debt to equity ratio, much more solid, and as a result, they were able to loan money during this time. And the bailout that occurred on Wall Street was exactly that, for Wall Street and not for Main Street. Some of the things that they put into the bailout package that Congress saw in their wisdom was a $2 million subsidy to produce wooden arrows in this country. Another one was to build a NASCAR racetrack. Another $500 million went to Hollywood film producers. Those are the types of, the word idiotic comes to mind, types of things that are going on in Congress that do not make any sense and that I think are detrimental to our country in the long term.
Mr. Downs?
Thank you. First of all, I want to thank Jack for clearing up the difference between commercial bankers and investment bankers. That helps us tremendously. One of the great things about talking last is the fact that I get to say less, so that works out really well for all of you. In addition to the comments and observations that have already been made, the main issues that the local banks, and I am talking on a more local level, the more pressing issues we see are we have more questions now on the safety of depositors' accounts. And so we are having to re-educate customers who have in the past taken for granted the fact that they can put their money in and not have to worry about it. They knew it was always going to be there. But now that they've watched the television, they've decided that maybe it's not as safe as it once was. So we are having to re-educate those people to say, hey, everything's all right. You know, you can't believe everything you see on TV. So, you know, just hang with us and everything will be fine. We are, as I said, reassuring them that we have a safe, sound, and secure place for their money. The other thing that has happened is we're dealing with FDIC insurance coverage going up to $250,000 per account. That in turn has caused us to have to pay additional premiums for that benefit. We're willing to do that. We enjoy doing that because we can get more money to lend out again and make more money. So there's not greed in there. It's just good business sense. Deposit rates have been reduced as well as in-house loan rates. The downturn in the home marketing area has led to a reduction in the number of homes being sold and the amount of mortgage applications. And when you don't have a lot of people that are coming in to borrow money to buy homes, then that is one of the biggest industries that keeps a community afloat, because those people are going to stay here, they're going to spend their money here, and they also will send their kids hopefully to Eastern, so that helps out Eastern as well. Long-term mortgage rates have increased, resulting in a reduction in the value of a home a customer can afford. You know, as interest rates go up, or well, let's back up a little bit. When rates were down in the 5% range, you could afford more of a house because your payment was going to be less. Now that they've jumped up 2 points, do you think you can afford that same house? No. Therefore, you know, some of the bigger houses that were built during that era or that period of time are sitting on the market and they're not being sold. So that has helped or affected our local economy as well, because those people that wanted to move and go other places can't get rid of their houses now in certain occasions. And even based on the above items and what we've talked about today, it's still business as usual. We're taking deposits and we're making loans, and we're going to be here for a long time to come.
Thank you. We'll move on to the set questions. And the first one is, how does this recession compare in severity to other historical U.S. financial setbacks, such as the Great Depression, the 70s, and the 87 crash? Dr. Whitaker?
During the Great Depression, which essentially lasted during the decade of the 30s, the unemployment rate hit 25%. Another severe recession that we had was during the time period from 79 to 81, unemployment rate hit 11%. Since that time, we've had a couple of relatively mild recessions. We had a two-quarter recession in 1991 following the dot-com bubble and 9/11. We had another two-quarter recession. Wasn't very deep, wasn't very long-lived. As far as the recession that we're in now, and we officially entered a recession today. The GMP numbers came out for the third quarter. It showed a decline of 0.3%. This is the first inning of the recession, so it's the early stages of the recession. As far as how severe it's going to get is something we're going to have to see as it plays out. I think that the expectation is that this will be a relatively severe recession. I don't know that it will be as severe as what we experienced at the beginning of the 1980s. I don't know that it'll get that severe, but some people are predicting that we'll hit an 8% unemployment rate. It's 6.1 right now. There's also expectation that this recession is going to be more than a two-quarter recession, that it may last 3 or 4 quarters before we start seeing an upturn in the economy. So it's going to be, the expectation is it's going to be more severe than the last couple of mild recessions that we had.
Okay, the next question. When do you predict the economy will become more settled and bounce back? And in addition to that, what key indicators in the economy do local business owners and investors need to track to help forecast the recovery?
Well, you know, I think the stock market is generally a leading indicator of what is going to happen. The unemployment rate is a lagging indicator, and I think that the basic underlying economy is really stronger than what has happened, and even the GDP number that came out today was for a decrease of 0.3%, which means that our economy is operating at about what it was in June of this year. So it's not a catastrophe by any means. And I would agree with Dr. Whitaker that this will probably be one of our more severe recessions, is that I think we will start to see us come out of it in sometime in 2009 and probably by 2010 for sure, because at least from our perspective of seeing what's happening out in the manufacturing sector, is that this economy really has a lot of resiliency to it. And I think a lot of it is due to all of the entrepreneurs that are starting new businesses that are happening out in the country today, and that there's much less of a dependence upon the big old companies like the General Motors and the IBMs and those big companies, that a lot more of our economy is driven by entrepreneurs, and those entrepreneurs are able to react and to stop and to start much quicker than what the big companies have been able to do in the past.
I think that over the next 12 months, we're probably going to get hammered by a succession of bad news after bad news. We're going to see declining operating results for firms. We're going to see declining GNP. We're going to see increased unemployment. So for the next 12 months, we're going to see just more bad news one after the other. The other thing that's going to happen is as the economy contracts, tax revenues contract. So the federal government's deficit is going to increase substantially above what it was this year. We're going to see a similar thing with state budgets, that they're going to have reduced revenues, and that's going to put them in difficulties. What we may see are increased requests for bailouts. They're talking about a bailout of General Motors and Chrysler right now. A couple of weeks ago, California started talking about a $7 billion bailout for the state. So I think we're going to start, they withdrew that request, but they at least mentioned it. So I think we're going to start seeing more and more things like that come up. As far as when the upturn starts, one thing I would look for would be an increase in housing prices. To know that housing prices have bottomed out and then start to increase is a sign that the worst is over. I'd look for an increase in quarter-to-quarter earnings of firms. If that starts increasing, it's an indication that the worst of it is over. As was said earlier, unemployment numbers are a lagging indicator. We're not going to see the employment numbers pick up until the recession is completely over with. So those are some of the things I think that we'll see over the next year.
What advice would you give to elderly people who have invested heavily in mutual funds and don't have the lifespan to ride out the stock market recovery?
Well, I think that, first of all, when you hear a question like this fairly often, and I think that one of the things that you have to do is step back and look at what's implied by suggesting that there's an elderly person who does not have the who doesn't have the life expectancy to wait out the recovery. Of course, there's really two types of recoveries we're waiting for. One of them is the recovery of the financial markets or the investment markets. The other is the recovery of the general economy. And those are not going to happen at the same time. It would be very unusual for them to happen at the same time. As Jack mentioned earlier, the stock market is a leading indicator. We would expect the stock market to recover first. And just to put this in perspective, I mean, if there's an elderly couple talking to me with this particular question, you really have to look at how long do we think that that the stock market or the investment market is going to be down. Historically, it has been down for fairly short periods of time. The longest that we've ever had the markets continuously go down since 1926 was 34 months. And that was in the Great Depression. And then it very quickly started recovering again. And to put that in perspective with respect to an elderly person's life expectancy, a 91-year-old has a 5-year life expectancy. So there aren't a lot of people out there who are really so old that they're not going to live long enough to see the recovery. The challenge then for them is not that they're not going to live long enough, but that they're probably, just like in normal times, the challenge is, are they going to live too long? And in the meantime, are their investments going to decrease so substantially in value that they start seeing an impact on their lifestyle? And what that couple really needs to be told is that that they can't really wait for it to be an emergency basis. They need to be looking right now at trimming their spending as much as possible to try to tap into this nest egg as little as they possibly can. Because, of course, while the markets are down, it's a very, very bad time to try to be pulling those investments out and feeding off of them. So I would start by saying, let's look and make sure that you're getting all of the government program money that you possibly can. Do you qualify for things like circuit breaker? Do you qualify for other types of assistance? And let's make sure that you're not spending more than you absolutely have to right now. And then let's tease this money out of your investments as slowly as we possibly can, because the recovery will come and you will be alive to see it, and we want as much of this money still there so that it gets the bounce when the market comes back. Just like a regular investor, I think that these people need to be cautioned against panicking and converting everything into what would be perceived as a safer investment, when in fact by doing that they might just lock in their losses, and they still might be living for quite some time and not have enough sufficient assets in order to sustain them for their lives.
You know, I think it really gets back to an asset allocation decision, and especially elderly people probably need to look at where they allocate their assets, and they shouldn't. When you're my age, you shouldn't have 100% in your in stocks. You should have some in bonds and in cash and in other assets. One of my concerns as I look at this, not just in the immediate term, but in the out 2 to 3 years, is that with what I'm seeing the U.S. government is doing of flooding the currency markets, and this is a graphic that I wish everybody could see, but it's a graphic that shows the monetary supply, and those of you that are in economy classes can better explain M1 and M2 and M3 to me than I can, but this is a graphic that shows the monetary supply, and you can see this spike up, that it went from about a 10% monetary supply up to 90% here. So the Fed is flooding the market with cash, and what happens to that is it eventually becomes very inflationary, and that's what happened in 2000 and 2001 when we had the crash in the dot-com. Is that then they flooded the markets with cash. Interest rates fell to 1% on the Fed funds rate, and that's what was one of the problems of what happened with housing prices. And I think we're going to be looking at another problem with inflation in the next 2 to 4 years. And if I was an elderly person, I would be looking at how do I take part of that allocation and put it into TIPS, which are Treasury inflation protection securities that allow you to have some protection against inflation. Right now, those are trading at about 3.5% plus inflation. So with an inflation rate that's running right now at 3 to 4%, you're getting about a 6 to 7% yield on those. And I think those are a way to protect you against inflation, because inflation is really the worst thing that can happen to all of us in this room. And it's a way for the government to tax us without us really knowing we're being taxed. And the inflation, I'm afraid, is going to pick up in the next couple of years because of all the money that's flowing into the financial system at this point.
Kind of what he was alluding to is what's called life cycle investing. And the idea there is that as you get closer and closer to retirement age, you move your investments out of common stocks, which are more volatile, and move them more into fixed income securities. And that's something people should do as they start approaching retirement age, not after they get there, but as they approach it. And that's one of the things that we teach in the Certified Financial Planner program that we have here at Eastern for anybody who's interested in applying to that program. I'd also add a couple more comments. As far as how fast things will recover. During the Great Depression were two of the best years ever as far as stock market increases, going from very low levels and going up over 30%. However, during the Depression, the time period between stock market peaks, that's when it set a new all-time record, and the next time it set a new all-time record was something like 13 to 14 years. During the stagflation of the 70s, the time period between market highs, when we set one record high and when we broke that record high, was another 13 to 14 years. When the dot-com bubble burst in 2000, we did not break that high until last summer, until the summer of 2000. So that was a 7-year time period before we set a new stock market high. In the current recession, it would not surprise me if it's not 10 years before we set a new stock market high.
The next question, where should the 20 to 45-year-old be investing money at this time? Yes.
Well, in my own case, my own 401k is now shrunk to a 201k. But the best place for young people to probably invest is in the stock market. And that right now, it's just like going into a supermarket where they're selling you 2 for 1. So you're getting 2 pounds of meat for one price, and or for a price that you paid 6 months ago. So you're able to buy a lot more stock than what you were able to buy 6 months ago. So those of you who are young enough and have a long enough time horizon, the stock market is still a place to be. But an even better place to be for you young people is to become your own entrepreneurs, to start your own businesses. Your generation, the millennial generation, is going to be the most entrepreneurial generation in the history of the United States. And there are going to be fortunes that are going to be made by young people such as yourselves, and I could tell you stories of dozens of them because I collect them, of young people between the ages of 12 and 27 years of age, which is the millennial generation, that is going to be the most entrepreneurial generation in the history of the United States. And your generation is already being compared to the generation of the 1880s, which was a generation that transformed this United States from a third world country into a world power, something we have never looked back from. So if you have got any ideas, start your own business. That's the best place. Invest in yourself, and that will be your best place to invest.
Okay, for the lenders, has your criteria for lending to businesses and individuals changed? And is it still possible for small businesses to get loans for operating and expansion?
Jessica, there's a question right before that these go along together. Is this a good time to start a business? I'm anxious to hear some of the other people's discussion on that. But in conjunction with that, our criteria hasn't changed. We still look at loans the same way we have for several years. We analyze tax returns. We look at past history, see how they're managing their business. We look at pro formas. What are they expecting for the next year, for the years to come, 3 to 5 years out? What's their capital position? How much do they actually have invested in this? What's their at-risk value compared to what we're going to be putting into this? So, and also we are doing what we always do, which is look at secondary sources too of repayment. You know, are the principals able to, if for some reason the business can't make the payments, can the principals cough up the money from their own private reserves? So there are other things to take into consideration. But is it a good time to start a business? I would answer that the same way I did with a lot of my questions that the professors did in our classes. That depends on the business. So personally, I think that with lower lending rates, there's more ability for companies like Jack said, entrepreneurs to get into it, provided they can get the capital backing. Because they're still going to have, even the SBA charges at least a 25% minimum investment before you can get into their program. So if they have the right backing, yes, this would be a good time to start a business.
I would agree with Dan and build on what he said. As speaking from someone in a very short time, I guess, and hopefully a very long career. Lending agents, please listen. But in all seriousness, I guess my point would be I'm cautiously optimistic. I'm in what I would call a mature business currently, but I start a new business every morning. We have to constantly evolve and change, I guess. As the market has changed, every morning I have to invent or reinvent how we're going to go to market. We compete with Walmart on a daily basis. You can imagine how easy that is. That just goes to show you that, you know, the small business, as Jack has mentioned, it does have a place in our community and our environment. I would encourage everyone in this room, take a chance, take a calculated chance on what you believe in, believe in yourself, and with the help of others such as are sitting at this table, as well as people at Eastern, you know, it's very possible. So I say fight on and go forward.
Okay, because East Central Illinois has lots of suppliers to the big auto manufacturers, what's going to be the effect on local businesses because of the turmoil hurting GM, Chrysler, and Ford?
We deal with a lot of auto suppliers all over the country, and what we see happening at GM and Ford and Chrysler is that they are losing massive market share to companies like Honda and Toyota and other companies such as that. And there's a major shift taking place of automotive production moving from centered in Michigan down to the south, down to Alabama and Tennessee and Mississippi and South Carolina and places like that. Today, there are more people working at making automobiles in this country than there were 20 years ago, which if all you did was watch Lou Dobbs, you would never believe. But you can look at the statistics, and there are more people today making automobiles than there were 20 years ago. But those people are often living in Mississippi and Tennessee and other states. And unfortunately, Michigan and the big three automotive manufacturers have gotten their cost structure out of line, and they have much higher costs to produce automobiles that puts them at a dramatic disadvantage. In addition, they have not adapted as quickly as some of the foreign manufacturers, and we are seeing a major shift that's taking place. It does not benefit Illinois. It does benefit the United States as a whole. We are sad to see that happening in Illinois. Unfortunately, from our perspective as a site selection consultant of looking all over the country, Illinois has a reputation of being business unfriendly. And until we turn around that reputation, we are going to be challenged to bring new industry into this state. And you cannot be pro-labor and be anti-business at the same time. And unfortunately, we have some politicians that do not understand that. And until we learn that, our state is unfortunately going to suffer, in our opinion, as a very small site selection consultant who's looking all over the country.
Okay. Everyone seems to agree that there is greed and corruption on Wall Street that put us in this mess. Do you feel that the local banking industry may also be to blame for offering home loans to people who cannot afford to pay them back?
Jessica, please pick me. This was my favorite question of all the ones that we got. So, no, I don't think that the local banking industry is the cause of the mess that we see, we followed the rules, got to know our customers, and evaluated their ability to own a home based on prudent guidelines and risk criteria. We acted as financial counselors instead of just a mortgage originator. Most of the mortgage issues were caused by mortgage brokers. Those were incented to provide loans to a mortgage company, not a bank, a mortgage company, based on a different set of lending criteria. In fact, I learned a new term for some of their loans. It's called a ninja loan. I don't know if anybody's heard that term or not. And that stands for no income, no job. They were clearly made based on the value of the property and a borrower's good credit score without really determining the accuracy of the property's value. You know, if somebody's selling a house for $60,000 and you've got a foreign company coming in and they ask somebody to do an evaluation, or they even do an evaluation online, which you can do if you want to sell your house, and it comes back at $80,000. Well, to those companies, that's a pretty good risk because now you're right below 80% loan to value. However, isn't it true that if you're selling the house for $60,000 and that's what you're buying it for, the value of that house should be $60,000? So if you make a 100% loan at $80,000, automatically you got $20,000 at risk. Additionally, with the availability of credit cards, people can live an awful long time on getting new credit cards, running them up, getting a new credit card, using that credit card to make the payments on the other credit cards. So you really have to get to know your borrower before you make that loan to them. And I think that's one thing that all of the local bankers are very good about. One of the other advantages to working with a local banker is the ability of the bank to work with customers that get in trouble. You know, we're not in the real estate business. We are in the business of making loans and collecting payments in order to get paid back for that. We don't want to sell people's houses. You know, nobody wins when a bank forecloses on a house. Everybody loses. The bank loses, the customer loses, and so we don't want to do that. So that's why you need to make prudent lending decisions. If delinquencies do exist in our portfolios, it's mostly due to the 4 Ds: death, divorce, disability, or downsizing. Unfortunately, these are hard to predict, and luckily we haven't had too much of the last one. So thank you for letting me answer that question. And I hope I did an accurate job.
Dr. Whitaker?
Yeah. This is really a loaded question. To put everything on so-called greed and corruption, I think, is an inaccurate portrayal of what's been going on. And I think it's, in a sense, a dangerous portrayal because it sets up a very anti-business attitude in this country. So I think it's kind of a potentially dangerous thing. I'll talk a few minutes about the government's role in causing this problem. The initial cause of the problem, the place it first started, was the Federal Reserve keeping interest rates low too long. That's where it initially started. Secondly, you've got the government-backed entities, or now government-owned entities, of Fannie Mae and Freddie Mac, who were the ones who went out and essentially bought about half of these mortgage loans. And that was their purpose, was to promote these types of lending activities. The regulation of banks is tilted toward encouraging residential mortgage loans. That's a governmental policy to do that. It shows up in the Basel Agreement, which is the primary bank regulatory agreement, that residential mortgage loans are only counted at 50% of capital, so it's lower rated than other commercial loans. They have even lower requirements on rated debt securities, and all these debt securities that were sold out there that are causing the problem were rated AAA or investment grade by essentially a government monopoly of rating agencies. You know, S&P, Moody's, and Fitch. If you want to sell your securities publicly, you've got to go to them and get it rated. And they did not do their job. They did not evaluate these securities and rate them properly, but they rated them AAA and allowed them to be sold all over the world. Does it cost them any business for that? Not a bit, because you still have to go back to them to get your securities rated. So what's the incentive to do a good job? That's where part of the problem is. You've also got the Community Reinvestment Act, which requires banks to make loans to low-income communities. So all of these things were pushing lending in that direction. You add to it the mark-to-market accounting rule, which was enforced by the SEC, which then precipitated this crisis. And you need to recognize that there's a lot more players involved in this than just one thing. Now, that being said, were there bad loans made? Oh, absolutely. Some of the worst loans ever, I mean, with unbelievable credit standards, were made. but that by itself is not the whole problem.
Dr. Whitaker and Dan have covered part of what I wanted to say with respect to this question, but I do want to add just a couple of things. And one is, first of all, I agree completely that it's a bit of a loaded question to sort of pin this on greed and corruption on Wall Street. I really think that most of what happened on Wall Street were players doing pretty much what we Americans expected them to be doing, which was pursuing profits in a method that they thought at least was prudent at the time. That applies to most of them. What happened here was really a failure of the people who are modeling the risk profiles on some of these securities to be able to do that accurately, and a failure of them to appreciate their inability to accurately model the risk profiles on these securities. And the one place that where I think Wall Street really did break down in ways that are embarrassing to look at is with the credit agencies. I think these the ratings agencies. I mean, it does appear that they really did engage in extremely substandard practices with respect to the type of due diligence that they expected of themselves, and the marketplace did not place a premium on accuracy of their product. And so those of us who are out there making investments found ourselves, like Fannie Mae and Freddie Mac, a perfect example. The preferred stocks on those were investment grade on Friday, the 9th of September, and or the 8th of September, and on Monday, the 11th of September, they were junk, and you could not find a buyer for those. And these rating agencies literally over the weekend just dropped the ratings down from one of the highest ratings available down to one of the lowest ratings available. So there was a real breakdown in that particular function of our system. So I also wanted just to go back to my days of practicing law and tapping into some of what Dan said. It was clear going back even a few years ago that there were very, very different practices on behalf of mortgage brokers versus banks in originating mortgages. And for lawyers who are out there closing residential real estate transactions, you could see the difference in the paperwork. And there was talk among the profession that there was a lot of falsification of documents that was becoming fairly common. We did not see this from banks, but on a very, very regular basis, it became the practice. I learned a new phrase, which was this phrase called gift of equity, which we started being asked to put on the settlement sheets as a way of basically bumping up the assessed value of a house and then pushing it back down by saying that the seller actually made a gift of that portion of the equity that was falsely put on the sheet to begin with. This became very common practice, and again, we saw that from some mortgage brokers, but not the more prudent local banks.
You know, I don't want to try to pretend that there wasn't greed taking place all over the place. It was not just on Wall Street. It was happening on Main Street also. There were people that were out trying to buy 30 and 40 condos that were under construction because the price of housing was moving up. But I think that Wall Street, in a way, got too smart for themselves. They were the rocket scientists run loose, if you will. And sometimes you get back away from the basics and you try to get too smart, is you end up shooting yourself in the foot, which is, I think, what happened with Wall Street. When you look at what is a mortgage and how it used to be made, is think of Jimmy Stewart in It's a Wonderful Life, where the local banker made a loan to you as a borrower for your house, and then he collected that loan, and eventually you paid the house off. Well, it changed a couple years ago when Wall Street got involved and said, hey, we can get involved in this act. There's a huge mortgage market. We will separate who's making the loan from who's receiving the loan. And so the mortgage brokers and local banks got involved in it also, but primarily mortgage brokers that made loans that they never had to worry about collecting. Well, if you don't have to worry about who you make the loan to because you're never going to have to collect it, is you're going to make loans to anybody. And it's human nature. You don't care who you make a loan to because you're never going to have to collect it. And that's what happened, and it really changed in 2002 when we went from looking at who were we going to collect the money from to where it became more important, can I make this loan and can I sell it to Wall Street? And if you made your payments for 90 days, those brokers didn't have to worry about it. And then we got involved in the regulators that made mistakes, that didn't do things right, and we got involved in all of these other securities. For example, you've probably heard of credit default obligations. Credit default obligations were zero 10 years ago. Today is a $60 trillion business. There's $60 trillion. I had to write it down. There's like 13 zeros in 60 trillion. 60 trillion, if you divide that by 300 million people in the United States, there is a $200,000 credit default obligation on top of each one of us in this room, which is just incredible that we went 10 years ago, we were able to operate without any credit default obligations, and today we've got 60 trillion of them hanging over our head, and it's why the government gave $85 billion to an insurance company by the name of AIG to get them out of those type of obligations. Doesn't make sense.
Thank you. Now we're going to move on. We actually have a few questions from our securities analysis class, and also if any of the audience members have questions that they wrote down on their note cards, please raise your hand and we will get them and then we can ask them as well. To start off, what advice would you give to current business students who are about to graduate, looking for a job right now in this tough job market? Yes.
I would find a industry that excites me, that I have passion for, and I would get a job there if I had to go and sweep floors. Because what you want to do is just learn. And you're going to learn more from these first jobs. I went and when I was 25 years old, I went and got a job and I didn't make any money for 10 years. I mean, I lost money in my first 10 years of my career, but I learned the things that set the base for me into the future. And so I would not be so concerned about what I'm going to make or where I'm going to go to work, but I would find something that I have a passion for, whatever it might be, and I would go to work at a company that's involved in that field. I would learn as much as I could, and 5 years from now, I would start my own business in that field because of that passion and because of what you learned during that period of time.
Okay, how will the $700 billion bailout affect inflation?
What, is everybody looking at me? Okay. Okay. Just on the $700 billion bailout itself, the way that this is set up, if it works the way that it's supposed to, presumably the taxpayers aren't going to lose any money off of this. So far it's been loaned out to banks at a 5% rate with other provisions in there. So as long as those banks survive, at some point in time this will be paid back. So if that's what happens, then by itself it shouldn't be inflationary. Now, the inflationary risks, though, are the increase in the money supply with the Fed policy that we're seeing. That's an inflationary risk. The other inflationary risk is if these bailout programs continue and expand beyond this.
I think it's going to be terribly inflationary, and we're going to see some of the worst inflation in our lifetime in the next 2 to 5 years because of all the money that's flowing in and because of all the other bailouts that are taking place. It's not just the banks. Now the automotive companies want to bail out the ethanol. There was just an article yesterday that every ethanol plant is going to get a $25 million bailout because they're in trouble. I learned last week that the buckwheat producers in North Dakota think they should get a bailout. And the thing just isn't going to stop and is just going to spread, and all of this will be terribly inflationary. And I think it's going to be in many ways it reminds me of the 70s, which I was just starting my career back then, but that was a very inflationary time. And unfortunately, when that inflation stops, as it can be very painful, which will be probably 8 to 10 years down the road when we finally wring that out of the system if we do.
What opportunities or changes for the good do you see coming from this situation?
It's caused us to be better as a small business. We have to, again, I mentioned earlier, we have to reinvent ways to go to market. You know, the doom and gloom of Wall Street, fortunately on Main Street, from our perspective, we've seen opportunities in the last 18 months that I have not seen probably personally in the last 10 years. We're excited. Everything that we're doing now is building on something that's going to happen probably in the next 8 to 10 months, and we think it's going to explode for us because we're seeking opportunities hopefully that others aren't or others can't. As I mentioned earlier, the position of a small business, at least from our standpoint, we cover a relatively small small geographic area in the state. The internet has been a valuable source for us. I'll give you an example. I shipped a vacuum to New Jersey in the last 6 months. Now, I'm assuming there's vacuums available in New Jersey the last time I knew, but for some apparent reason, thank you to the guys that invented Google, we're now able to have an opportunity to service anybody in the United States. And I promise my service is just as good if you're in Hawaii, New Jersey, or anywhere else as it is if you're at Eastern and I'm delivering to the college. So we're excited, and the opportunities I think are going to be abundant, even though there are pressures in regards to the national level. So I'm very optimistic about the future.
Would closer regulation of the Federal Reserve Bank help to stabilize monetary policy? And if so, what regulations might you suggest?
Well, the Federal Reserve is the regulatory agency. So they're the ones who do the regulating. There's nobody who regulates them. I guess the argument that's going on right now is that if you look at, strictly speaking, what the Fed is supposed to do, it conducts monetary policy, and it's supposed to stabilize the price level. However, the Fed has conflicting missions in which they are also trying to stimulate economic activity. And those two missions conflict with each other. And that accounts for some of the problems that we've had in recent years, where they abandon price stability for the purpose of stimulating economic growth.
So how will bailing out companies such as Chrysler and GM help the general public and individuals?
Can I take the other side of that?
How will it not?
I don't think that it is the government's responsibility to bail out companies. I don't think that it should be capitalism on the way up and then socialism on the way down. And if we don't bail out a Chrysler, is that somebody else will pick up those pieces and will do a better job, and will be able to cut costs out of the process by picking it up at a bargain. And so Cerebus Capital, which owns Chrysler, a big LBO outfit, a big hedge fund, shouldn't be bailed out of their billions of dollars of investment that they made, but we should let the market work, because the market is a much more efficient allocator of capital than what our Congress or the people in Washington can ever be.
All right, unfortunately, we're out of time for the audience questions. So now we'd like to ask for some final comments. So please limit your remarks to 3 minutes. Dr. Whitaker, would you like to start?
Questions?
Questions?
As a 30 to 40-year-old with no debt, would you recommend going into debt and investing in the stock market today?
No. Okay, I generally don't recommend people going into debt. The only time you'd want to do that is if you're making a higher return than what you're getting off of interest. The other comment is going into the stock market right now. Right now, the stock market is the most volatile that it has ever been. It's making unbelievable moves, both up and down, on almost a daily basis. I am somewhat skeptical that we are at the bottom. You know, there's more news out there. It would not surprise me to see the stock market have further declines from where they are today. So I would I would not be rushing into major investment decisions at this point in time. I would let things stabilize a little bit.
Which presidential candidate's tax and economy plan do you feel will help get our country back on track?
We appreciate no loaded questions.
Yes.
Thank you for that question.
Is that candidates living or dead?
You can say no comment.
No.
Okay. Will well-capitalized investment banks or investment brokers, hurt small banks?
No, I mean, I think that there will always be a need for small community banks in every location because people want to deal with people. They don't want to be just a number. They don't want somebody out in California or New York or some other place to have to call them up on the phone, or even if you can video them on the computer or whatever. You know, you still can't get that straight across from the person and get the feel of, okay, if we get in tough times, are you going to work with me or not? Well, if you're far away and there's a computer in between us, no. You know, it's really easy to detach from your borrowers. However, if you're right there in front of people, it's a little bit more enticing to try to work with them and get them back on track. So I don't think that the investment brokers, I think they serve their purpose in the areas that they operate, but I think that this is going to help small banks and small community banks especially. So.
What do you see happening to the strength of the dollar in the near future?
I think the dollar is probably going to strengthen in this worldwide crisis because there's a tendency for capital to flow to the location of strength. And so as we saw, for example, when Iceland essentially imploded, a country of 200,000 or 300,000 people that had deposits in their banking system of something like $500,000 for every person in the country, when all of that imploded because they brought in money from Europe, when that imploded, those dollars tended to come into or those funds tended to come into dollars. So I think you've seen during this crisis that the dollar has really strengthened here in the last several months, and I think will probably continue to strengthen during this time of crisis.
I would just add to that we can see very, very active in the investment world, that there's a lot of active movement of other countries seeking out dollars right now. I mean, Korea recently, I'm not sure what the arm of the government was, but South Korea recently purchased from some of the South Korean investment banks $100 billion worth of loans that those banks have yet to originate. They're loans that those banks are supposed to go out and get in U.S. dollars because that's how much they want dollars to flow into Korea. So I think that you see things like that going on in various countries all over the world. So at least the short term, people are scrambling for dollars, and I think that's going to really buoy the value of the dollar.
You know, the dollar strengthening at the present time, and some of this reflects kind of a flight to safety, since this is a worldwide crisis. It's not limited to just the United States or Central Illinois or anything of that sort. A larger concern that's going on, though, is that over recent months the government's taken on has guaranteed substantially more liabilities than what they had in the past. And if that continues, then at some point in time the countries loaning money to us might start to question that. If you think back a year ago when the dollar was still declining, there was a lot of talk about oil perhaps being priced in euros rather than dollars, about countries moving to euros or something like that as their reserve currency. If that ever happened, it would be one of the major economic events of our lifetime. We get a lot of benefits out of being the world's reserve currency, and that's something we certainly hope is going to continue.
Okay, thank you. We'll move on to the closing remarks. So just keep it to 3 minutes. Do you want to start, Dr. Whitaker?
Sure. I guess we've heard a lot of good comments today. I appreciate the comments of all the other panelists. They've certainly added to my understanding of the situation. I think I'd summarize that this is the this is the most significant economic event of the last 75 years. So this is major news that's going on right now, and the final outcome of this is not yet resolved. The other thing I would add is that the policies that promote economic growth are lower taxes, lower regulation, and free trade. Those are the three things that the government can do to promote economic growth. During the Great Depression, government did exactly the opposite of those things, and that's one of the main reasons that the Great Depression lasted for a decade.
Again, from a small business perspective, again, cautiously optimistic, again, is how I would phrase where we're at from a position both within a local perspective as well as a statewide perspective and on from there. Again, opportunities are around, both for us as a company as well as many of the companies that we are involved with, where there's a supplier, there's manufacturers, and on through the chain. Again, I would recommend, you mentioned earlier about people that are entering the job market or are currently there, what to do. I think take calculated risks. Make sure you use your resources wisely. Gene mentioned the SCORE chapter and things that we've done to try to strengthen our position as a small business in order to allow us to have the resources to continue to grow. We've been here 62 years, so I fully intend for us to be here another 62 years. And, willing and continuing to do things well, we're going to build on that. Again, I agree with a lot of the things that have been said today and have learned quite a bit by being up here. So I do appreciate the opportunity to speak with you this evening.
We've heard a lot of, or some discussion this evening about the interconnected economies, some of the world markets versus the United States and so on. And of course, here locally, we are connected with what's happening on Wall Street, even if that connection is tenuous, as some of the comments have indicated. I think it's important, sort of as a way of closing things, to remember that we are in central Illinois and we're not in one of the major metropolitan centers, and that has been a big advantage, I think, for those of us who live here. We did not, in this local area, experience the real estate bubble that happened in many, many other parts of the country, and we have not subsequently experienced the same kind of bursting of that bubble. And so for those of us who don't spend a lot of time traveling to those other areas, some of the stories you hear are kind of hard to believe, because we really don't see this stuff happening around us locally. So there's a good reason to be fairly optimistic as we move forward. And I know our business has been hiring people in recent times. Other businesses are growing, and we certainly do have some hard times ahead of us as a nation. And some of that's going to affect us locally, but I think we all need to realize that we are blessed in many ways to be where we are at this particular time, and we have very good business community. It's a good place to be.
I think when you're in a time of crisis, it's difficult to see the clear sky out in front. But if you look at past crises that we have had here in this country, I can take you back to 1970. When we had the first oil shocks and OPEC was going to take over the world. And then in the 1980s, it was Japan that was going to dominate the United States, and there was a block in the center of Tokyo that was worth more than the entire state of California because of their inflated values. And then in the 90s, it was the giant sucking sound to Mexico, that all of our jobs were going to flow out of Mexico. And during all of this time, our economy continues to grow and to get better. And then in the late 90s, it was the Y2K that was going to paralyze the entire country, and then the bird flu that was going to kill us all, and we weren't going to be able to leave our houses. And each of those crises passed, and now we look back on them with a little bit of humor. We look back on them and say, well, that really wasn't as bad a crisis as what we thought of. And as I look to the future, I think that the best days of the United States don't lie in the past, as Lou Dobbs would have us believe, but our best days lie in the future, and it's because of the young people in this room and your creativity and your entrepreneurial spirit that are going to make this country much better than what it is today, and that we're going to look back on the crisis of 2008 in 10 or 20 years and go, that was a tough time, but we came through it, and we were better for it, We wrung some of the excesses out of the system, and as a result of that, we built a better base, and we are today a better country than what we were in 2008.
Well, first of all, I'd like to say thanks to Jeannie and Dr. Knoll for giving me this opportunity to be part of this illustrious panel. Secondly, I want to thank Jake and Jessica for doing such a great job. I think they need a round of applause. And third, I'd like to say, as you've heard, we're in unique times. The local banking community, and I want to clarify local banking, I'm talking about the First Neighbors, the First Mids, First Financials, Citizens, all those local community banks, whether big, small, whatever, we're all in this together, and we do a great job. Very competitive against each other, but we work well together in times like these. We'll continue to provide opportunities to customers to earn a safe return on their investments and their deposits, and we'll use those deposits to provide lending opportunities to our business customers, consumers, and mortgage borrowers, and based on prudent lending practices. And in other words, it's going to be business as usual. Thank you.
Didn't they do a great job?